Throughout the multitude of financial specialists and investing gurus in the world, one name sticks out above the rest: Warren Buffett, known as the Oracle of Omaha. Warren Buffett has accumulated wealth over a career of careful and disciplined investing rather than via flashy schemes designed to make quick money. And that is what you will be learning today. Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. In this video, we will explore some of his best investment lessons, what to avoid, as well as how to apply them in your investment strategy. Excited? Well, I am! So if you're ready, without further ado, let's start the video. Warren Buffett's investment journey is full of stories that demonstrate his long-term investment philosophy. Take a quick guess on what was the most successful investments in his career. I'll give you 5 seconds. And while you're at it, click that subscribe button for us, will you? It'll mean a lot. Now, if you guessed Coca-Cola, you're right. He invested in this company in the late 1980s because he understood the business and saw its intrinsic value. Despite market fluctuations and many critics arguing that the soda industry was in decline, he held onto the stock. He bought Coca-Cola stock because of its strong brand and business model, which he not only understood but held value in. He knew people loved the taste of Coca-Cola and that its global brand recognition gave it a significant competitive edge in the market. Despite occasional market fluctuations, Buffett held onto the stock even as critics argued that the soda industry was in decline. Another example of Buffett's investment philosophy is his relationship with Berkshire Hathaway, which he started investing in the 1960s. It started as a failing textile mill, but has grown into a massive conglomerate that owns and operates a variety of enterprises. During this incredible transition, Buffett demonstrated extraordinary perseverance and absolute trust in his investing decisions. Instead of racing to turn a profit as soon as possible, he gave careful consideration to building a broad portfolio of well-run businesses over time. Today, Berkshire Hathaway is one of the most valuable companies globally, serving as a testament to Buffett's buy and hold philosophy. These cases emphasize Buffett's primary tenets. So with these stories, what can we learn from Warren Buffett? Here are 6 things you can learn from his investing journey. First is thinking long-term. This is extremely important when it comes to investing. According to Warren Buffett, investors shouldn't make decisions about their investments based only on how well a company does in the near term. Rather, investors have to seek out businesses with strong fundamentals and the potential to generate substantial returns over an extended period. Next is investing in what you know. This philosophy revolves around buying stocks that have a margin of safety. It means that investors purchase cheap equities whose genuine value has not yet been completely recognized by the market. Investors can avoid risks and increase rewards in this way. Next is staying within your circle of competence. As mentioned earlier, Warren Buffett advises investors to stay within their circle of competence. This way, investors can make informed decisions based on their understanding of the market. Another thing you should know is the notion of hold for the long term. He believes that buying and selling stocks frequently can be counterproductive and can often lead to losses. Instead, investors should focus on holding stocks for an extended period and wait for their investment to grow. Another one is to reinvest dividends. This means that investors should use their dividends to buy more shares in the same company. This way, investors can take advantage of compound interest and maximize their returns. And of course, be regular and consistent in investing. Warren Buffett recommends that investors engage in a consistent and systematic approach to stock market investments. By doing so, investors can take advantage of the strategy known as dollar cost averaging, allowing them to purchase stocks at various price points and thereby mitigating their overall investment risk. Do you have any other lessons we can learn from Warren Buffett? Comment down below. Now that you know the things you should do for a clean investing journey, you should also know the common pitfalls to avoid when it comes to investing. Warren Buffett's advice is not just about what to do, it's also about what not to do. So, here are 4 common pitfalls you should avoid. I'm sure you heard his famous saying, "Be fearful when others are greedy and greedy when others are fearful." This short quote captures his advice to steer clear of the herd mentality, which is a common mistake made by investors. It's simple to get carried away by the exhilaration and frenzy around a hot stock or market. However, making investments based only on feelings will always end badly. First-time investors should concentrate on logical analysis and make autonomous decisions based on in-depth research rather than going with the flow. About herd mentality. Avoid this mindset. Herd mentality refers to the tendency of investors to follow the masses, either piling into the next big thing or selling off in droves during a market downturn. Buffett advises against this. Instead of acting impulsively, first-time investors should take a long-term view of their investments and avoid the noise of the market. Another common pitfall to avoid is to don't try to time the market. Trying to time the market by buying stocks at a discount and selling them at a premium based on prevailing market patterns is one of the biggest mistakes new investors make. Buffett cautions that predicting short-term changes in the market is not so much a competent undertaking as it is a game of luck. Rather, he suggests taking a long-term hold and invest strategy. The idea is to commit time to remaining involved in the market rather than trying to time the market. The last thing to avoid is ignoring daily stock price fluctuations. As a long-term investor, Warren Buffett doesn't concern himself with the daily ups and downs of the stock market. He understands that stock prices will fluctuate in the short term due to various factors, many of which have nothing to do with the underlying business's health. Warren Buffett advises first-time investors to adopt the same mindset and not let short-term price changes distract them from their long-term investment strategy. Well then, that's everything you need to know. These lessons and guides from Warren Buffett will serve as your guiding light as an investor. Remember that although achieving financial success may not be easy, you will be well prepared to make wise judgments and steer clear of trouble in the future if you have Buffett's tried and true ideas at your fingertips. Thank you for watching. If you like this video, please don't forget to give a thumbs up, comment, and hit that notification bell so you don't miss out on our following videos. Here's to your financial success. Happy investing, everyone!